Hello, everyone. My name is Kevin Liu, the equity strategist with CICC Research. Welcome to our new program of podcast of CICC Insight. Thank you for joining me today. We're going to talk about the recent wave of A-share listing in the Hong Kong market. Since last September, 8 A-share companies have been listed in the Hong Kong Stock Exchange, including industry leaders such as CATL and Media, raising a total amount of 98 billion of Hong Kong dollars. There are still nearly 50 A-share companies have announced their plans waiting in the line to be listed in the Hong Kong market. We believe the overall supportive policy environment, increasing market trading activity, and specific business needs such as expanding their overseas business activities and attracting more foreign investors are probably the main reasons behind this growing number of A to H listings. Along with the recent wave of more A-share companies to list in Hong Kong market, we also notice an interesting trend that for certain stocks like CATL, its price in Hong Kong market is actually trading at a premium versus its A-shares counterpart, which is actually quite uncommon given the Hong Kong market's relatively light liquidity and also the difference in investor space compared to A-share market. However, for certain quality names, there are certain occasions that H-shares can trade at a premium versus its A-share counterparts for two reasons. First, it is aligned with the overall macro and industrial trends. And second, it meets the criteria and preference for foreign investors to do the stock selection. When selecting companies, for example, A-share investors tend to prefer smaller caps with more upside potentials. But for foreign investors, especially for long-term and value investors, they preferred larger cap quality names. That is the reason behind some large cap quality names are trading at a premium in Hong Kong market. On top of this, several short-term trading and technical factors, such as relatively smaller IPO offer size, ample Hong Kong market liquidity recently, the stronger investors' enthusiasm and sentiments, as well as the expectation for rapid index inclusion and passive fund flows might have also contributed to the current premium for the case of CATL. The recent macro and market circumstance, we think, might also have gave H-shares relative advantages for different type of investors. For example, for Chinese mainland insurance companies, they are more willing to buy H-shares high dividend yield assets to meet their liability side because of the Hong Kong market high dividend have relatively higher dividend yield. For mainland China individual retail investor and relatively flexible trading funds, they are more willing to participate in leading names driven by structural opportunities in Hong Kong market, such as biotech, new consumption, and internet companies. And for foreign investors, although they remain overly cautious on the overall market, but they prefer certain high-quality blue chips reflected by recent IPO price and enthusiasm of inflows. Lastly, we believe that the growing number for A to H listing could make the structure of the H-share market more balanced and better to reflect the overall structure of Chinese economy, with more industrial healthcare, and consumption leading names to get listed in Hong Kong market, which in return would attract more funds, more inflows to stay here, to create a virtuous cycle between market inflows and more high-quality companies to list it here. That is all for today's program. If you are interested in our research, you can find it on our CICC Insights official website. This is Kevin Liu. Thank you for joining with me today. See you next time.